Good afternoon, everyone. Good afternoon. Thank you so much for joining me on Brian Financial Empowerment's Financial Lives. We do this every Sunday afternoon at 4:30 p.m. Eastern Time. Going forward, we're going to only be doing this on YouTube. We will not be doing it on my Facebook Live page, only on YouTube. So today I'm very excited to discuss the topic, which is the 1040 form. The forms are due, filing is due on July 15th, which is this Wednesday. And I thought it would be great to have a discussion on the form. And I am going to be giving just an overview of the various lines that are on the form. I am not your tax advisor. I am not your attorney. So I want to give a disclaimer before I actually go into the form, the discussion of the form, that I am giving you general information that you can take to your tax preparer and have them review, or you can do a better job of reviewing your tax return when they give it to you. You can have questions to ask based on the information I'm going to be giving you. So again, this is a disclaimer. I am not your tax attorney. I am not your tax preparer. Therefore, this is not considered legal information. This is not considered tax advice. This is general information around the 1099 form. Okay, so with that said, let's dive right in. For those of you who are joining me for the very first time, thank you so much. I'm Dr. Severin Bryan. I am with, my company is Bryan Financial Empowerment, LLC, and I have been teaching financial literacy classes for over 18 years, but I just recently started my business full time. So the business name is Bryan Financial Empowerment, LLC. You can find me on the website at sevtalksmoney.com. You can find me on Instagram at sevtalksmoney. You can find me on Twitter at sevtalksmoney. You can also find me on YouTube as Severin Bryan. Okay, so let's dive right in because time is precious and I don't want to waste your time. I'm going to go ahead and share the 1099 form so we can actually see, and while I speak, we can actually see the form. So let's do that. Okay, StreamYard, let's share the screen. Okay. All right, we're gonna go here. And I want to, if you can let me know in the chat if you can see the, okay, this is not sharing the screen. Let me stop. I want you to tell me if you can see the 1099 form once I share it. I don't know why Firefox is acting up. There it is, 1099. Okay, please let me know if you can see the 1099 form in the comments. Okay, I am not seeing your comments. So I am going to assume, okay, great. Somebody said yes, they can. All right, so let us talk through the form. Okay, filing status. This is not, let's go back to StreamYard. Okay, filing status. Now you can see that there are several filing status on the tax form, and it matters which one you choose. I've seen married folks choosing married filing separately, and another one choosing head of household. That is not legal, okay? So be very careful when you choose your filing status. For those who are filing single, typically, if you're filing single, it means that you've never been married. If you're filing single, you've never been married. You are divorced. You have been divorced before the end of the year. By 12/31 of December of 12/31 of 2019, you've been divorced, or you've been widowed before January 1st of 2019. So if you've been divorced before 12/31 or by 12/31 of 2019, your status is single. If you've been widowed prior to January 1 of 2019 and you have no kids, your status should be single. Okay? Now we go to married filing jointly. Of course, that's pretty self-explanatory. You're married, you file together. If you're still married as of December 31st, 2019, then you file married filing jointly. Of course, you can do married filing separate, and we'll talk about that a little bit later. If your spouse died during 2019 and you didn't remarry, you can file married filing jointly if you were able to do that while your spouse was still alive. So if your spouse was still alive and you were able to file married filing jointly, however, they died during 2019, you can still file married filing jointly. Okay? And the other situation where you can use married filing jointly is if you were married at the end of December of 2019, but your spouse died in 2020 before you filed. So let's break that down. You're married at the end of December 2019. You're still married, but it's now July and you haven't filed your return yet. And your spouse died in 2020 before you file your return, then you can still file married filing jointly for that first year. Okay? I hope that's clear. All right, so the next status is married filing separately. You might want to choose this status if your spouse has significant debt. Maybe they have garnishments. They have, there is a possibility the government could come after them for their money, for their refund. Then you might want to file married filing separately to protect yourself. Okay, you end up paying more taxes, but it helps to protect you if your spouse's income or spouse's refund is in danger of being garnished. Okay, the next one is head of household. For head of household, you need a dependent. You cannot file head of household without a dependent. Come on, folks. I did taxes for a number of years, so I've seen it all. Okay, married. If you're married and you lived apart for at least 6 months, for the last 6 months of 2019. And you can file a separate return. You can choose this head of household. But there are various tests. And if you have a dependent you supported for more than 50% of their support, you can choose head of household even though you're married. But there are lots of different criteria related to that. So you want to if you're in this position, you want to talk to your tax attorney or your tax preparer to find out if this is a good fit for you. Because for all of these situations or all of these filing statuses, there are things that you can do to get around them, but you have to make sure, because tax is never black and white. Tax is gray, very, very gray. So you have to understand where you can fit into that gray area to take advantage of it. Because you see all those companies that are not paying taxes, all those rich folks that are not paying taxes, they know how to use the tax rules. And even though we might fuss and say, why are they not paying taxes? They're just using the laws. They're using the legal, they're going about it legally. They're using the rules to take advantage. They're taking advantage of the rules to not pay taxes. So you and I, we don't have a big lawyer that we can have on retainer to go through the tax codes. and to do the search and find all this information. But if you know enough, then you can talk to your tax preparer to take advantage of all the different options that are available to you. And then, of course, the last status is qualifying widow or widower. Okay, for this one, remember before I said if your spouse died in 2019, that you can file married filing jointly, and if they died before 2019, you can file as and you have no kids, you have to choose single. Well, for this one, for you to choose qualifying widower or widow, your spouse has to have died in 2017 or 2018, and you have a qualifying dependent, a qualifying child, a qualifying stepchild, in order to choose the qualifying widow status. Okay? So if your spouse died in 2019, you have to do married filing jointly. If your spouse died before 2019 and you have no kids, you have to use single. Okay? All right, so now let's go through the line items, and we'll go down through the first line. And I can't tell if you're seeing this or not because my screen is all messed up. Okay, I'm hoping that you can see the lines right here. We're looking at lines 1 through 11. Okay, the first line, of course, is pretty self-explanatory: wages, salaries, and tips. Right? You're going to get a W-2 form if you get tips, if you get scholarships, grants. Those types of income would go on line 1. Now, for tax-exempt interest, if you've gotten a 1099 OID or a 1099 INT, which is interest, the OID is original issue discount. 1099 OID, if you've gotten one of those, or if you've gotten 1099 INT, which is 1099 interest from your bank, this is the line you'd put it on. The 2A is where we would put exempt interest dividend, and that is like interest from municipal bonds, because typically those are exempt from tax. The money that you get, the interest you get from your bank, is what you would put on to be the tax for taxable interest. And there's a Schedule B that you can go in and you can fill out all of that information, and it will roll over here to this line. Or if you're doing it manually, you want to fill out the Schedule B with all the required information so you can tell where what should be added here as taxable interest. But in general, interest from municipal bonds and things like those are exempt from tax, and you would put it on 2A. Things from interest from your bank, you would get on the 1099 INT, and you would put it on line 2B, okay? Now, for qualified dividends are if you own investments, if you own maybe stock, and you get some dividend from the whoever's managing your stock, you get some dividend paid to you. Qualified dividends usually is taxed at a lower rate. In ordinary dividend is taxed like your ordinary income. Ordinary income and ordinary dividend is taxed at a higher rate than qualified dividends. Okay, so things that would be, your qualified dividends would actually end up lowering your tax rate. Let's see, what else? 1090. And you get that on the 1099 DIV, 1099 dividend. Is that form. So I guess I'm giving you the forms also because I want you to be able to take that form when you get those forms from the various companies and authorities or employers or whoever. Then if you know what that form represents and where it goes on the tax return, that's going to help you, because then when your tax preparer gives you a return, you can have questions for them. You can say, hey, you didn't put the information on here, because here is what I'm in with my experience with some tax preparers. What I'm seeing is they have the software and they're entering the information, but they don't understand the logic behind the information that you're entering in these software. Anybody can go out there and buy some software and plug numbers. But if you don't understand what the numbers represent and where they should end up on your return, you get a return and you get a nice refund, and you say, oh, this is great, but the return is wrong because they don't have the information in the right place. So my purpose here today, again, is just to give you a general overview of what these lines are and the forms that will be attached to each of these lines. Okay, so where was I? What line was I on? Capital gain. Okay, so of course your Schedule D is what you would fill out to get the information to determine whether you have a capital gain or capital loss. And assets held a year or less, you're filling out, you need information for assets held a year or less, or assets held more than a year. You need that information separate, and you'll fill that out on the Schedule D, and that information will roll over into line 6. And your capital gain, you're going to get, you could possibly need to file a Form 8949 if you're not deferring any capital gains. Okay, so something to keep in the back of your mind when you have that conversation with your tax preparer. And of course, you add all of that together, and then this is your total income so far. And then on line 8A, we're looking at adjustments to income. Now, if you've looked at your tax form before, you see that the tax form had like maybe 60 plus lines. Well, if you're looking at 2019, you'll see that it's been significantly shortened. And the reason for that is they have taken some of the lines off, and they've consolidated them into Schedules 1, 2, and 3. So information like that you see before on this first page for like alimony or education credits or things like that, it's still available, but it's summed up into these schedules, and I'll talk about those when we get to the next page. But anyway, so far you have all of your different income, all of your different taxable income, all your different non-tax income. You're going to add it up here, and on line 7B, this is your total income. Then adjustments to income, which is Schedule 1, from line 22 of Schedule 1, you're going to fill out Schedule 1, and those kinds of adjustments could be alimony received, and we're talking other income, alimony received, unemployment, state tax. You know how when you file your state tax, you do get a refund? This is where you would put it. Typically, it would be on, I think, line 2 or 3 is where they would have it on the older forms. But now it's consolidated into Schedule 1, and you would put those kinds of income on that schedule, and it would roll to this line 8A, okay? And then after you've added the total income, any adjustments to income, this is your adjusted gross income here on 8B or AGI. This is a very important number to know, because a lot of times if you're dealing with IRS or other tax software, they're going to ask you for your AGI from the previous year in order to identify you. So you have to know your AGI from the year before. Make sure if you don't get a copy of your return from prior years, that you know that AGI number. Okay, then your standard deduction or itemized deduction. All right, it's very clear what the standard deductions are. Single or married filing separately, your deduction is $12,200. Let me say something about deductions. You have your total income, you have all these additional income. Now you have a net income or adjusted gross income. What your deduction does, it reduces your tax base. So if my income is $100,000 and I have adjustments, other income, other adjustments, and I now get to an adjusted gross income of $80,000, that is my taxable base. This is the base that's going to be used to calculate tax. Okay. Now, adjusted, my standard deduction or itemized deduction further reduces the AGI. So now I have a new taxable base. Deductions reduce your taxable income. Credits reduce your tax. Okay? You want to make that distinction very clearly. You want to get credits because after you've calculated your tax and you owe the government $1,000 and you have a credit of $500, now all you owe the government is $500. It's a straight 1-to-1 ratio. But when you're on your standard deductions, when you reduce your AGI, no, it's not a clear 1-to-1. You're just reducing it for them to now calculate tax. And I'll explain a little bit about the tax system and how the rates work in a little bit. But your standard deduction, you go ahead and take that based on your filing status. Here's the thing though. If your itemized deduction is less than your standard deduction, you can end up using that and it's a more favorable result for your state return. So let's say, for example, your standard deduction is $20,000. Well, it's not $20,000. Let's use one of the numbers here. Your head of household, your standard deduction is $18,350. Okay? And when you calculate that, typically your federal, depending on what you have, let's say your federal, you owe $100 and state, you owe $50. Okay? Work with me here. You did your standard, you did your thing, you using the standard deduction, you owe federal 100 and you owe state 50. If you use your itemized deduction, I can almost guarantee, even though it's lower than the standard deduction, I can almost guarantee you that you will end up maybe owing federal a little bit more, but your state position will be a lot better. So what you want to do when you calculate your taxes, you want to try to use the standard and you want to use the itemized even though it's less than your standard, just to see which one brings you at a more favorable position. Okay? And then, of course, qualified business income deduction, that's pretty self-explanatory. You're going to use Form 8995 or Form 8995A. And another thing I didn't mention at the beginning, there's a new form for those who are 65 and over, and it's called Form 1040SR. It's not the typical 1040. So if you're 65 and over, you want to make sure your preparer is using the Form 1095SR. Okay? So now you've done all those, you've applied your standard or itemized deduction, your qualified business income deductions, and then now you come to the income that you're going to use the tax table to calculate what you owe the government. Okay? Now, our tax system is graduated, meaning that if you're single and you make let's say 20,000, the first I think it's the first 9,750 is going to be taxed at 10%. And then there's a next tier. So it's breaking your income where the first so much is taxed at 10%. Then the next, depending on your filing status, because the filing status depends on what the amounts are that are taxed at the various levels. So your first so much, and I don't have the table right in front of me, is going to be taxed. Just go ahead and you can Google tax tables. Your first so much is going to be taxed at 10%. Then the next amount, maybe between like 9,000 and 15,000 or something like that, is going to be taxed at a different rate. And then the next amount, and the next amount until you get to the max of your income. So when people say, oh, my tax rate is 15%, it's really not a true 15%, because your rate is graduated based on what the tables say for your filing status. Hope that makes sense. Okay, they're using a graduated level. So you have the first so much is taxed at 1% at a certain percent. The next amount is taxed at a certain percent until you get to whatever your total income is. Okay, so then tax is calculated on your income, and so now we're at lines 12. Let's go over there. All right, so now we're at lines 12 through 24, and you can see how short this form is, right? I mean, I can remember the form. I think it had like 68, 70 lines. Ooh. So this is a vast improvement. Okay, so now you've calculated the tax based on that table, and there are situations, there are circumstances sometimes where you have to do a special tax table. You don't do the normal tax table, but for most of that's pretty rare. Okay, so you calculate your tax, you have your tax right here. So now we come to the gravy part of the tax return, which is the credits. So let's say you calculated your tax, and your tax is now at $1,000. You owe Uncle Sam, and you don't have $1,000. Don't be scared. Don't worry about it. This is the part where you want to make sure you have some leverage, or some of these options. You want to have them available to you so that you can reduce that tax that you would owe the tax authority. And the first one is the child tax credit. And of course, the child tax credit, you have a child, right? You can't just take it because you feel like you want to take it. You have to have a child to take the child tax credit. Now, for Schedule 2, it's saying here, well, let me go back. 12B, on line 12B, these are other taxes that you could owe. So 12A is a tax that you calculate based on your income, that your adjusted income that you've calculated based on that first page. And so now you're on the second page, you put that tax on 12A. 12B is where you could have maybe additional tax, like the AMT. That's the alternative minimum tax. If you end up having that tax calculated, then you want to add that tax here. So now you add 12A and 12B together, okay? And then 13A, of course, is a child tax credit. 13B are credits such as education credits, retirement savings contribution credits, general business credits. Now, there are income limitations again with this. If you made, if you're over on the first page, if your taxable income is $90,000 for head of household or more, the government thinks you're making a lot of money. The government thinks you're rich. So the government says you cannot take any of these credits. Okay? So if you're making I think it's 80,000, if you're making 80,000 or more, I think for single, and married head of household, I think it's 90,000. But in any case, the government says you're rolling in the dough. So you can't take the education credits. You can't take some of these other credits, retirement savings contribution credits. You can't take any of those. I don't know where they're getting that from. Sitting up there in Washington acting a fool. But anyway, so you can't, there might be income limitations for taking these credits, but just know that they are available. So the education credits, retirement savings contribution, general business credit are some of the credits that you can take on 13B. Okay, so now you're going to add those, and then you have Schedule 3, line 7, and you're going to add all of that together, and you're going to get your total tax, your net tax so far. Okay. Then you have other taxes, which is on line 15, and that could be additional tax on IRAs, maybe self-employment tax. That used to be on the first page. Self-employment tax, tax on IRAs, those sort of things. That would end up being on line 15. But of course, you're going to be filling out the Schedule 2 and the Schedule 3 to determine, to add all of that information up, and if any of that applies to you, then you would add it here as a credit. So you're going to subtract, and now you have your net tax. Then on line 16, of course, you're going to add, that's your total tax. Line 17 is where any taxes that you've had withheld from, whether it's on your W-2 or 1099, because sometimes when you get your distribution, the companies may take tax out of it. So if you've had tax withheld from your W-2 or any of your 1099 distributions, then it would go right here. And now you're saying, okay, the government is saying this is a tax that I calculate, this is what you owe, and you've already paid me so much, so what's the difference? Do you owe me or do I owe you? And then you're looking at other payments and refundable credits, and it's broken down here into A, B, C, D, and E. And those could be earned income, earned credit income, and earned income credit is one of those that would go there. And of course, it's based on it has income limitations to it. So not everybody will be able to get the earned income credit. Typically, if you have no kids and your AGI is less than 15,000 something, 15,500 something, I think, then you would be able to claim the earned income credit. If you have one child, it goes up to a certain amount of income. If you have two, it goes up to a certain amount of income, and three and more, then it goes to, that's the last tier. And you would put that information on the schedule, calculated to see if you are qualified to take the earned income credit. Then on line 18B, that is additional child tax credit. The child tax credit, let's say your child tax credit is $1,000 that was calculated. But because your income or your tax that was calculated is, say, 800, because remember, the credit reduces your tax, right? So let's say your tax is calculated at 800, and your tax credit that you should get is 1,000. Well, you don't have enough tax to be reduced, so the extra would go here. This is where it go. The additional child tax credit will go right here. So they allow you to be able to take the child tax credit, because the tax credit, even if no tax is calculated on your return, you get a refund from the child tax credit. So if you owe the government nothing and they give you the child tax credit, you can get that money directly in your account as a refund. So they want to make sure that you're able to get it, even if you didn't have enough tax for the credit to be applied against. And then the American Opportunity Credit, that's for if you are in school in higher ed, and for the first 4 years of your degree, you can take this American Opportunity Credit. But again, there are limitations based on the income, because Uncle Sam said you're rich, so you might not be able to take the American Opportunity Credit. Okay, so on D, this is let's say you filed an extension and you paid the government, you paid for the feds an amount with that extension, then that would be applied here. So they're saying you owe me so much, but you already paid this amount, so we're going to take that amount from what you owe. So that all of that added together becomes your total payments and refundable credits. And once you add and subtract all these different areas, then this is your total payment. And if it's a positive, they owe you. If it's a negative, you owe them. So that's pretty much the 1040 form, and what you should be looking for when you talk to your tax preparer. And again, I am not your tax preparer. I am sharing general information that you can take to your tax preparer when you file your return. If you want additional information, or you want to discuss something that is a little bit more in depth, then you can contact me and make an appointment via my website, www.sevtalksmoney.com. If you go to LinkedIn, to Instagram, I have my calendar connected there. If you go to Facebook, my calendar is also connected there. And you can make an appointment if you want to talk about anything that is more in-depth regarding your tax situation. But again, this is just a general review of the form and the kinds of things that you need to look at when you talk to your tax attorney. So I want to see if anyone has any questions at this time, and for some reason I cannot see if there are any questions on YouTube. I cannot see. Let me see if I can see it on my phone. I am trying to see if there's anything on the phone. So are there any questions? Any questions that anyone has? Okay, let me close this out. Yeah, there's an echo. All right, anyone has any questions? If no one has any questions, then I will close out the broadcast. Am I just not seeing the questions, or let me make sure my volume is on? Anyone has questions? Okay, apparently there are no questions. I still see about 15 persons are online, so I'm not sure if I'm just not seeing the questions, and I hope that's not the case, because I want to be able to answer your questions that you may have, because you took your time to watch the broadcast, so I want to be able to honor that and answer any questions that you have. But I am not seeing any questions. So if there are no questions, then I will go ahead and close the broadcast. And again, I want to thank you for joining me. We're going to do this 4:30 p.m. Eastern Time every Sunday afternoon. If there are any questions or any topics that you want us to cover, then please, you can contact me on my Facebook business page, which is Brian Financial Empowerment LLC. You can contact me there. You can send me the questions, and I will be able to address those in an upcoming broadcast. You can contact me on my website, www.sevtalksmoney.com. If you can contact me on YouTube. I have some links there too that you can contact me. Also on Twitter, I have all my links in my link tree on Twitter, and I think that's